Right, good morning everyone and welcome to our update of the 21st of April 26. Today we need to discuss the trusts or that trusts has entered the section 210 regime, the 210 penalty regime, and the fact that this is just an expansion, not a revolution. Lots has been made in the media about this, but I think it's important that I just give some context behind this penalty. And just explain it just to calm everyone down because everybody seems to be up in arms. It's good that SARS is trying to enforce compliance. It's fantastic, but just look at it calmly and deal with the situation. For those of you who don't know me, I'm Nico, Managing Director of Unicus Tax. Please bear in mind for those of you joining online that this session is intended for my staff, and for those of you joining online, really just for your interest's sake. Right, so let's talk about this trust penalty. Right, the legislative underpinning which is what is important to understand. It's not, SARS's website is not the law, people. They say things on their website, and that's good. You can go and check on their website for interest's sake, but it's not the law. Please don't take what they say as the law, despite the fact that they might think that they can make announcements or make law by publication on their website. Sometimes they don't. Right, so the legislative underpinning for this penalty is section 210, and contrary to popular belief, it doesn't penalize all incidences of non-compliance automatically, right? It's for a specific incidence of non-compliance that's listed in a public notice. So there must be a non-compliance, but this non-compliance must be of the sort that is listed in a public notice, right? So it's not anything, right? And then, of course, we all know that the penalty that you get for this incidence of non-compliance is the fixed amount penalty that SARS imposes, right, 250. We'll look at the table just to refresh your memories again, right? And so all that's happened is that trusts have been added to the list of incidences of non-compliance, or the non-submission by trust tax returns, we'll get into the detail now, is added to the list of incidences of non-compliance that can be subjected to this penalty. But it's not new. This is not a new penalty. I mean, the first notice that was issued under section 210 was issued in 2012 when the TIA was just released. And you'll all recall that this was the first one where they said, okay, natural persons, failure to file tax returns, we're going to penalize you. And then you had to have more than 1 year outstanding, and it had to be after a specific year of assessment. You'll all remember that, right? But that is the first one that we had. And then a couple of years later in 2017, they said, well, there's certain reporting obligations that you have in terms of transfer pricing and OECD guidelines. If you don't comply with those, then we're going to give you a penalty for non-submission of those returns. And again, an extension of that in 2018, also mostly related to transfer pricing. Some diamond export levy returns, failure to file those were added, and then the one that everybody will remember is then companies' failure to submit a return was added to the penalty for, or this section 210 penalty. Then in 2021, we had the revision of the 2012 version of natural persons failing to file tax returns. They widened the scope. Remember that, because initially there was a cutoff and you had to have more than 1 year outstanding, and then they changed that later in 2021. So the 2021 notice was simply, I think, an expansion on the 2012 notice, and then of course now in 2026, trusts were brought into the regime, right? So once a trust falls into this incidence of non-compliance, we'll look at the detail, then of course they can get the penalty, which ranges from anything between 250 to 16,000 Rand a month, right, subject to statutory limits. I think it's 35 months, you guys can correct me, but I think it's like 35 months if SARS has your address and 47 months if they don't have your address. So for every month that the non-compliance persists, they can impose this penalty, which amount is determined based on the prior year taxable income, and if they don't know, they'll guess. Right, so when you look at the preceding year taxable income, you can see at 250 Rand a month. I mean, it's a penalty. It can eventually get high, right? Up to, of course, 16,000 Rand a month, which is quite significant. But then you should be having taxable income of above 50 million. I would venture to guess that somebody above 50 million looks at a 16,000 Rand a month penalty in the same way as somebody looks at a 250 Rand a month penalty. But the point is, it's not. It accumulates over time. So clearly, their intention is for you to go and fix this. Right? So this is not new to trusts, by the way. This is how all those other incidences of non-compliance that I've referred to earlier all fall subject to this penalty, and this is the way it's determined. Right? So that's important to understand that, again, this is not new. Now, what is important, there are limits to when SARS can impose this penalty. So it's not all trust tax returns that are outstanding that SARS can impose this penalty for. It's limited. And again, you won't see this necessarily on SARS's website. You have to go and read the actual public notice, which is published on SARS's website, right? So the notice says it only applies in respect of tax returns outstanding for years of assessment commencing on or after 1 March 23. Right? In other words, for most trusts, tax returns from 2024 onwards, they're outstanding, you're going to get this penalty, right, of 250 Rand a month or whatever the penalty is. Now, bear this in mind. I'm not trying to suggest that if you've got tax returns that's outstanding before 2024, you don't have to file them. Be careful of that, because we saw previously when they did the individual tax one in 2012, I had it on the slides earlier, it was imposed on a fixed deadline or a fixed cutoff, and then a couple of years later they expanded it, right, and removed the cutoffs and those sorts of things. So I expect this is just the initial rollout. They would eventually expand it to later. And of course, the fact that SARS can't impose this particular penalty doesn't mean they've got other enforcement actions that they can take against you for failure to file a tax return, including an understatement penalty. Right, so just be careful, don't be fooled by the fact it can only, as it stands at the moment, they can only impose this penalty for 24 years onwards, right? So that's important to understand. Right, so what is important also to understand, because there's this 4 May deadline that's been in the news, which is partly SARS is doing, is where they said that from the 4th of May, SARS is going to start issuing penalty assessments. You've all seen the penalty assessments on the AP34, PA, whatever the thing is called, right? So they said on the 4th of May, they're going to start issuing penalty assessments. But when you look at the public notice says, okay, hang on, before you can impose this penalty, you're supposed to, as with companies, you're supposed to issue the trust with a final demand, telling them that there is non-compliance, telling them to fix it, and giving them 21 business days to fix it. And only then, if the trust does not comply with that deadline, then only can SARS impose the penalty. So there are limits to this, right? Now, what is important to understand is this notice, this public notice that brought trusts' failure to file tax returns into the Section 210 penalty regime was published on the 27th of March, right? And SARS said on the 4th of May they're going to start running penalty assessments. But in February, SARS had said they'd already started issuing final demands to trusts, and that the public notice will be issued in due course. But when you look at the public notice, it says SARS must, if the trust is now non-compliant, they must give this trust a final demand. And they must say you've got 21 days to fix it. And in that final demand, they must refer to this public notice. So how could the final demands issued in February be compliant with the law, right? And this is important because these penalties, these fixed amount penalties, are nuisance penalties to get rid of. Like, that's what we do for a living, is dispute resolution. I know they're difficult to get rid of, and there's caps and stuff to it. So you need to understand to what extent is it possible to impose. And in the context of penalties in general, guys, when in dispute resolution, everybody tends to think of penalties in the context of dispute resolution, remission. I must ask for remission. I did something wrong, I must ask for remission. That is not the starting point. The starting point is was the penalty legally imposed? Because you'll find, more often than not, that it was not legally imposed. So there's a big difference between asking for remission, which is an acknowledgement of you did something wrong and that the penalty was correctly imposed, versus I'm challenging the imposition of the penalty because it was not imposed in line with procedural fairness and procedural provisions, right? And so already you can see this issue with February final demands with the public notice has not even been issued. But I think insofar as trustees are concerned, I mean, what do you do now? Certainly don't panic and panic file tax returns. I don't think that is the idea, because we all know that trusts in particular, their tax returns can get quite complex. Of course, some trusts are straightforward, right? But some trusts do get quite complicated, and so you know where your exposure is in terms of this penalty, right? And make sure that you are compliant, but just don't rush and file tax returns, because the risk of getting it wrong, the penalties that you face in getting it wrong, I can almost guarantee you, is much higher than the penalty you'll get for failure to file a tax return. And again, I'm not suggesting don't file, right? I'm saying pay attention to what you're doing and don't be caught up in the panic and the rush. Yes, it has to be done, but it has to be done properly, right? And important is, if you do end up getting this penalty, ask the question, was this penalty incorrectly imposed? And if it was correctly imposed, then of course you must go and consider the grounds for omission. But like I said before, right, the crux of these penalties, and it's not unique to trusts. I've had many requests from people. We tend not to do them because the quantums are too low. But for penalties on individuals for failure to file tax returns. And when you look at the remission provisions in section 217 of the TIA for these penalties, right, the remission provisions are very narrow. Must be a first incidence of non-compliance or involve a non-compliance of less than 5 business days, reasonable grounds, etc. And then they can only remit up to 2,000 Rand. Right? So if you've got someone who comes to you with 47 months worth of penalties sitting at 100,000 Rand, I can almost guarantee you the cost of doing a remission request is going to exceed the 2,000 Rand benefit you could possibly get. Right? Because technically there's a cap on how much they can remit. And again, that's why it's important not to only consider whether remission is the correct angle of attack, but whether imposition can be challenged. Because if you challenge the imposition, there's no cap. There's no up to 2,000 Rand. It's not supposed to be there at all. I'm not asking you for remission. I'm not standing with my proverbial hat in my hands. I'm asking for remission for the penalty not to be there. So this is not a revolution. This is simply an expansion of the penalty system. SARS is widening the ambit and scope of section 210. The answer to dealing with this is not hysteria, certainly not complacency either, right? It's disciplined compliance. Sit down, check what's wrong, and especially because what's going to happen now is you're going to have a bunch of trusts, and that's the aim of this, right? Which is fair. SARS is forcing compliance, it's fine, we're going to check if they're doing it properly in terms of the proper procedure. But what's going to happen is you're going to have a bunch of trusts file tax returns which are non-compliant, and those are going to be selected for audit or verification, most of them, right? And so you want to be in a position where you know that that tax return is correct, that the beneficiary distributions are correct, that 7C has been dealt with correctly. How many trusts have I seen where they go and they file trust tax returns, right? And they've got these massive loans, right, payable to beneficiaries, right? And nobody looks at 7C. Right? I had a case a while ago where somebody said, no, we realized that there's a 7C issue for this year. And I said, well, send me the financials for the last 3 or 4 years. I said, well, it's actually an issue for these previous years. Send me all the financials. Oh, it's actually an issue for since 2017. Right? Nobody looked at this, or people miss it, especially those distributions to beneficiaries that are left outstanding on loan account. If we look at 7C, right? But that's not the only issue with trusts. That's important to understand. All right, so I think that's the point for today's session, is just what is this trust penalty thing? It's not new, it's just an expansion of the existing system to trusts, only for 24 years onwards, and they must issue a final demand before they impose it. So that's what we check for. All right, so as is now become my custom, is I will, before I take questions, just discuss a case we're working on for interest sake, or that we worked on. I just want to switch to questions here, and I'll go to your questions now. For those of you who have questions, you can start posting them in the chat box. We've got a case, interesting case, where SARS had done an audit on a taxpayer on VAT, right? And this taxpayer didn't charge VAT on a certain fee that it charged to fellow group companies, right? And how they structured this fee, so this is their thinking, or this was their thinking, how they structured this fee is they said, well, look, it's a management fee that is a cost recovery, because I employ all the staff and then I put the staff everywhere in the groups, which is fairly common practice in groups, right? And they charge a management fee to recover the cost, right? And they thought in their mind they don't have to charge VAT on those fees that they charge, because in their minds it's salaries, right? And I can see the frowns in the office for those not working on the case. And that was clearly wrong, right? I looked at the facts, I said, okay, fine, this is subject to VAT. They should have charged VAT, they didn't. So the only thing we're disputing is the penalty, the understatement penalty that SARS imposed. I'm not challenging the VAT is the VAT, that's what it is. But SARS had imposed an understatement penalty. And so we are now fighting this penalty. And remember, when you penalize a taxpayer in terms of the understatement penalty system, you need to look at how guilty the taxpayer is. What sort of reasonableness would you expect of a taxpayer? Would a reasonable person have made this mistake or not, et cetera, et cetera? And funny enough, halfway through this dispute, SARS comes along and they do an audit on one of the fellow group companies. And they say, you can't, in the group company, you can't claim this input tax because this is salaries and wages. Right? So do you see the irony? in the position. SARS says, I'm going to raise output tax and I'm going to penalize you for getting it wrong, but their own auditors make exactly the same mistake in the same group, but in a different company. And so that bodes well for my negotiation on the understatement penalty to say, well, look, I mean, if you don't get it right, how do you expect the taxpayer to get it right? So is this penalty fair? Right, so that's just an interesting case that I thought I'll share. Anyways, let's go to questions. Right. Passive trust has to be filed, yes. Passive trust, I think I looked specifically at the notice that says who's supposed to file tax returns. So you'll recall that every year there's a public notice that says which taxpayers must file tax returns. It's not the commissioner waking up one day and saying, I feel like putting this on the website. There's an actual government gazette that goes out that says these are the people that must file tax returns. That's also where those limits that you'll also hear on the radio, specifically on e-filing, if you've got more than 500, then this, then that. It's all set out in the public notice, so it's a legislative process. And I looked at the last notice, and I think some of you might, if you in the room or some of you on the call might correct me, but I think that public notice had said a trust that is a resident must file a tax return. Dormant or not, doesn't matter. In fact, it was only recently when that notice started excluding dormant companies, because it said the same for companies. If you're a company, you must file a tax return, dormant or not. And then I can't remember how many years ago, I think maybe 5 or 6 years ago, they started introducing certain limits for dormant companies. But insofar as trusts are concerned, my understanding is if you're a trust, you must file a tax return, dormant or not. And if you've got taxable income of nil and you haven't filed your tax return, the penalty is 250 Rand every month until you file the tax return, provided you got the final demand, no? And the 21 days to fix it. Right, then we've got a question here. If it's a VAT late payment that can be written off in terms of the VAT Act, it's an objection or a request for remission. Let's talk about this issue, because I actually complained to SARS head of legal recently about this confusion in the industry. When you are disputing only and what Marika is referring to here is a late payment VAT penalty. When you look at the Tax Administration Act, that is a percentage-based penalty, properly so defined in terms of Section 213, right? And so what the TAA says, it says that if you are going to challenge a percentage-based penalty, like a late payment penalty for VAT, like an underestimation of provisional tax penalty, like a late payment penalty on PAYE, those are all percentage-based penalties. Your first port of call, if you are disputing the penalty only, is to file a request for remission, right? If SARS then comes back and they say, I'm not allowing the request for remission, then you can object to that decision, right? That sequence is important, but it seems that SARS has different practices about how they do it, because some taxpayers say, I filed a request for remission, SARS invalidates it, and then they say, I must do an objection, I do an objection, they say, file a request for remission. So there seems to be a lot of confusion, but the right process is file a request for remission. I just recently filed a legal notice on SARS. Who helped me? On exactly this issue. To say to them, you've prevented this taxpayer from following a procedure which has cost him 3 years worth of dealing with your issues and you taking collection actions when you are the one that's in the wrong, right? The correct procedure is to file a remission request first, if it's a percentage-based penalty or a fixed amount penalty for failure to file a tax return. Right, so the right process is a request for remission if you're not disputing the capital tax. The way we do it often is, we often do it in combination. So remember, when you are doing a remission request, I've said this earlier, you're accepting the capital adjustment which led to the penalty, right? So the way we tend to do it is, if I'm looking at an assessment, let's call it VAT, let's use Marik's example of VAT, where there's SARS disallowed the 0 rate, for example, imposed some VAT on the standard rate, and then a consequential 10% penalty. I'll file an objection, an NOO, to the capital adjustment, and I'll file a request for remission without prejudice to my objection. The idea is that if the objection fails, my request for remission is already in. And I'm filing my request for remission without prejudice, lest it be seen that I'm conceding to the capital. Right? And then SARS will say, but you can't do this, you must do that. But it seems like they're confusing what their systems allow with what the law says. Nothing in Section 215 that deals with request for remission says you can't do a request for remission if you're doing an objection. There's nothing like that. I mean, and also what is important to understand is, because some SARS officials I understand will say that, is you can do the request for remission after the objection process is finalized. But when you look at Section 215, it actually says you must file a request for remission. There's timelines for this. It's by legislation. It says you must file a request for remission before the due date for the penalty payment, as per the penalty assessment, which is normally the end of the month, or you guys can help me, or at the end of the following month, or the month in which the assessment is issued. Right? So it's not like there's nothing in the legislation that says go and do an objection first, and if you then, after that, then you can only file, or your time for remission only starts to run then. There's nothing to that effect. In fact, you're supposed to do a request for condonation. Right, let's see. And understatement penalties levied automatically.